Okay, so you know how sometimes the stock market just starts acting weird? Well, that's exactly what happened at the end of last year. All of a sudden, the winners started losing, and the losers started winning. So today, we're going to put on our detective hats and solve this thing. Is this a real change in the market, or is it just some kind of illusion? And this, right here, is the heart of the mystery. How did stocks that were basically in the doghouse all year suddenly come roaring back to life? And at the same time, the champions, the big tech names, started to fade? It's a puzzle that's had a lot of investors scratching their heads, and we are going to get to the bottom of it. So first, let's just set this scene a little bit. By almost every measure, 2025 was a fantastic year for the markets. I mean, the S&P 500 was on an absolute tear, its third straight year of double-digit gains. And the tech-heavy Nasdaq, it soared with a return of roughly 20%. It was a year of really clear, undeniable winners. But then, something shifted. As the year started to wind down, around November and December, the whole script just flipped. The very stocks that had been giving us those amazing gains started to stall out, and this new group of leaders began to creep out of the shadows. And that, my friends, is where our mystery really begins. So, what's the evidence here? Every good investigation has to start with the facts, right? And the data we have tells a really compelling story about this sudden, pretty unexpected switcheroo. Just take a look at this chart. You've got sectors that have been trailing the pack for most of 2025. We're talking materials, industrials, energy, and boom, all of a sudden, they started crushing the broader S&P 500. You could literally see the money flowing out of the old leaders and into these beaten-down parts of the market. And here's the other side of that coin, the so-called Magnificent Seven. You know them, the huge tech giants like Apple, Microsoft, and NVIDIA that had basically carried the market on their backs. Well, they were suddenly lagging behind. The generals just weren't leading the charge anymore. And that divergence is the real puzzle we need to solve. So this brings us to our first major theory. Let's call this suspect number one, the idea that we're watching a genuine, honest-to-goodness rotation in the market. So what exactly is a fundamental rotation? Well, think of it like this. A smart team manager trades a star player who's at their peak value for a couple of really promising rookies who have more room to grow. Investors are doing the same thing. They look at these really expensive, crowded stocks, then they look at these cheaper, overlooked stocks whose businesses are actually getting better, and they decide to swap. It's a strategic move based on value and future growth. And the case for this theory is actually pretty strong. It suggests that investors are deliberately moving their money away from those giant tech stocks that have gotten, let's face it, pretty expensive. And instead, they're hunting for bargains in these other areas. The fact that more stocks are joining the party, what we call the rally broadening out, is usually seen as a really healthy sign for the whole market. But hold on, there's another suspect in our lineup, an equally compelling explanation. Let's call this theory number two. It's not about fundamentals at all. It's just a case of seasonal shenanigans. Okay, so this theory says that everything we're seeing has way less to do with how businesses are doing and everything to do with, well, the calendar. It suggests this whole rotation thing is just a temporary illusion, one that's created by very predictable year-end market habits. The first piece of this theory is a little strategy called tax loss harvesting. Here's the deal. Late in the year, investors sell their losing stocks. Now, they're not doing this because they think the companies are bad. Nope. They're doing it to generate a loss that can cancel out gains they've had somewhere else. It lowers their tax bill. It is purely an accounting move, nothing more. And here's how that little trick can warp the market. First, all that selling in November and December pushes the prices of these losing stocks down even further than they should be. It's artificial pressure. But then, as soon as the calendar flips to January, poof, that selling pressure is gone, and investors who are now free to buy those same stocks back cause this big surge in demand, which leads to a sharp rally. It's a totally mechanical bounce. And that mechanical bounce leads us right into our second seasonal idea, the famous January effect. This is a well-known historical pattern where the biggest losers from the year before often become January's biggest winners. And why? Precisely because of that tax selling and rebuying cycle we just talked about. So let's put our two suspects head to head. You've got a real rotation, which is driven by improving business fundamentals and could, last a long time. Then you have the seasonal effect, driven by taxes and the calendar, and it's probably going to be over pretty quick. One is a real signal of change. The other is basically just market noise. All right, it's time for the final verdict. We've looked at all the evidence, so which one of our suspects is the real culprit?
And the verdict is, it's a little of both. Plot twist. The truth is that there's probably some genuine rotation happening, but it's getting supercharged by these powerful seasonal effects. And that brings us to the most important point of all. The goal isn't just knowing that stocks moved, it's understanding why they moved.
Because really, our mission here isn't just to solve this one little puzzle. It's to give you a framework, a set of tools that you can use to figure these situations out for yourself the next time they pop up. It's about helping you become a better market detective. And here it is. This is your toolkit. To tell a real trend from a temporary blip, you've got to ask these key questions. First, are earnings and cash flow actually getting better? That's the fuel for any real sustainable rally. Second, who's buying? Is it big institutions making long-term bets, or is it just a quick technical bounce? And finally, does the valuation even make sense? You have to ask if you're paying a fair price. Answering these questions, that's how you can tell a durable turnaround from a simple trick of the calendar. So I'm going to leave you with this. The next time you see the market doing something surprising, pull out this toolkit and ask the hard questions, because knowing how to figure out if it's a durable turnaround or just a trick of the calendar, well, that can make all the difference in the world.